Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. On the program tonight, I want to focus on the war and how you should invest on the basis of could it be over quicker than we expect, or if it drags on, how should you invest? My first guest is Brenton Saunders, who's the portfolio manager of the Pendle Mid-Cap Strategy Fund. I asked him about how he's playing the war, what kind of investments is he thinking about because of it? And I also get him to take us through the good value mid-cap stocks that he's added to his fund, and some really interesting companies, looking at companies from about 50 to 150 in the ASX 200. He gives us a few really interesting ideas. And then Marcus Bogdan of the Switzer Dividend Growth Fund and Blackmore Capital, he looks at how he's playing the war and the stocks he's recently added or taken away from the fund. And then Dr. Shane Geha, he's an expert on urban planning. I've got him talking about the future of CBDs, and then I do a bit of analysis on REITs, real estate investment trusts, particularly those focused on offices in the CBDs. Are they stocks that you should sell, or are they potentially good value? I look at what the analysts are actually saying about some of the big name companies in the REIT space. That's the show. Let's kick off now with Brenton Saunders from Pendle. After a market crashes, we tend to find that value stocks do really well compared to growth stocks. And a lot of value stocks are mid-cap stocks. That's why I'm interested in talking to Brenton Saunders, who is the portfolio manager of the Pendle Mid-Cap Strategy. He joins me on the program. Thanks, Brenton, for coming on the show.
Thank you, Peter. Nice to see you.
All right, mate. So tell us about the strategy for this fund.
Peter, the strategy for this fund is really to take advantage of companies that are really in the sweet spot of their development. So they have sufficient maturity to be able to generally pay dividends, have established and self-funded capital structures, but still have a high focus in terms of their business model. So they're not too diversified or spread around. And they also still have a reasonable level of growth. We look for, companies in good market segments with good management teams and, a good story, somewhere where we think we can identify some kind of information edge where we think the market is not taking into consideration how the story will play out.
How many companies would you have in the fund on average?
We typically have somewhere between 40 and 60. That's sort of what we target. I think we have about 49 at the moment. So that compares to our investment universe, which is 100. So the investment universe is from in the ASX 200, it's from the 50th biggest company to the 150th biggest company. So that's largely the size of company that we invest in. And if you looked at that broadly in market cap terms, that's from, in very round numbers, around $1 billion to around as much as 8 or 9 billion.
Yeah. And do you actually search for a preferred diversification ratio between sectors, or is it purely driven by how many really good companies that you can find?
I mean, it's a difficult balance. We are a core manager, so we don't really have a style bias. We typically will go anywhere. The nature of the benchmark in that 50 to 150 has a very wide diversification across industry segments. So it's quite unique in that regard. It's not overpowered by like the ASX 200 would be with a very heavy weighting in large banks and resource stocks. It has a much more balanced investment universe, and we typically have a fairly diversified portfolio. We try and find the best stocks in their respective industry segments. It is opportunity driven to some extent in terms of the number of really good companies we can find, and that's typically why we limit ourselves to somewhere around half the number of stocks compared to our benchmark. But we tend to keep it fairly well balanced across industry sectors.
And I presume you end up getting some pretty good quality tech companies that really haven't made it, like the afterpays that end up being in the top ASX 100, even top ASX 20 at one stage, I think it got to. But so you do actually get quite a range of good quality tech stocks in there as well, I presume.
Yes, you do. And, that's the one part of our universe that, is still characterized by fairly developmental companies. Some of them are still reliant on external sources of capital. They're not self-sustaining because they're such high growth enterprises. And we find that not just in the tech space, but in some of the EV space as well. There are similar kinds of companies that trade on similarly very high multiples, or mostly developmental concept stocks in large part, but we do. You mentioned Afterpay. Afterpay came into and out of our universe in fairly short order as it rallied through the COVID stimulus period. But stocks like NXT, YSEC, and the like, they all form part of that universe, and they're all pretty much as tech as you can get.
Yeah. So you got an interesting conundrum now, I would have thought, because I think they're good quality companies, but at the moment the market is has rotated out and have a pretty negative view. But when people ask me, I think, well, a lot of these companies are going to be great companies in 2 or 3 years' time, but it might take a year or so before they come through. How do you juggle like that kind of view and the fact that you have to produce results?
Yeah, look, there's 2 parts to that, right? So there's the first part is it a good company? Is it in a good market segment? Is the market structure a good one? Is the management team a good one? And is the opportunity set ahead of them? And a lot of those big tech companies in our investment universe tick most of those boxes. One of the boxes they're not ticking at the moment is really just valuation. The rise and the prospective rise in risk-free rates and interest rates is really the biggest headwind for a lot of highly valued stocks like those stocks. So, there are some tech stocks that we are less disposed to just by virtue of either the market segment they find themselves in, the management, or their opportunity set generally. But there are a lot of really good companies with good opportunities in front of them. The biggest headwind is really just from a valuation perspective. Most of the high multiple stocks are finding it fairly difficult in this current environment with the prospect of rising interest rates.
How are you treating the big headwind coming out of Russia and Vladimir Putin at the moment? Are you seeing it as a buying opportunity on the basis that eventually some kind of solution will come out, and as we saw overnight, one whiff of something good and bang, the market goes up? How are you treating the Russian-Ukraine war?
Very carefully, Peter. We're not necessarily convinced that this is really. We think it's probably too early to be bottom picking any kind of sort of market bottom based on what is going on specifically, not only in the Ukraine, but as far as the interest rate backdrop and inflation is concerned. So we are maintaining fairly defensive portfolios that are populated by some of the best quality and lowest valuation stocks in our space at the moment. And we are trying our level best to stay on top of developments in the Ukraine, and just to try and have the most educated view on how that might play out and ultimately when that will give the market confidence to find a level and unwind some of these anomalies that have been priced into the likes of commodities, and then obviously some of the stocks that are more specifically impacted by the events.
Do you have like a two-road view on the stocks you hold? Ones that you think you'll make money well in the short term, and others you're prepared to bank on that they will be great performers down the track?
Yeah, I mean, the stocks that we really like at the moment, and some of our bigger and better holdings are companies like Metcash, Nine Entertainment, Downer, Tabcorp. Those are some of our bigger and more higher conviction holdings. Each and every one of them are for slightly different reasons, but you'll find that the common thread amongst them is most of them are reasonably valued. Most of them have a fairly good cyclical backdrop, and they're relatively well positioned for an environment in which we have rising inflation and rising interest rates. We're not a macro thematic investment house. We try and diversify as much of that risk out of our portfolios as we can, but we're very cognizant of whatever cyclical drivers that are helping or hurting a specific stock or sector.
But even before the Ukraine Russian conflict, I was arguing probably at the end of last year that I thought the Australian stock market had an opportunity to do well compared to the US market, because the US market had ripped, if you compare where it was before the pandemic, it was up about 38% and we were up about 4%. But because their tech stocks, the FANGs and Microsoft, really drove that up. And I just figured that, cyclically the miners would do well, financials would do well, and energy probably had a benefit from the fact that a global recovery was coming. Financials have clearly suffered because of the Ukraine, what in the hell is going on with banks situation. If we get past the Ukraine thing, do you think those three themes will still be work in our favour with a global recovery coming out of Omicron and coronavirus?
Yeah, I think so. I think once the mist clears and we get back onto investing around some of the sort of more traditional macro dynamics outside of geopolitics, that at this stage of the economic cycle is typically highly favorable for specifically the banking stocks, possibly less so some of the diversified financials, but certainly banking looks quite good. And then, I think the one thing that we think that will continue to be well positioned post, the resolution, stabilization, hopefully of the Ukraine is just ongoing disruptions in commodity markets. That is likely to keep commodity prices, energy prices at above trend levels. That should help, Australia as a geography, and we're lucky to be endowed with a lot of very good companies in those spaces. So I think that will continue to favour us, depending on the extent or eventuality of any kind of additional stimulus that may or may not come out of specifically in Europe, the Ukraine war. We might well see some of the tech stocks find their feet again and start doing well again. But we do think that that's a space that, just from a rating perspective, is going to continue to battle with interest rates and inflation for some time.
I often argue that the interest rate story is hard for tech stocks, but eventually some fund managers who will make so much money in other sectors will look at tech stocks and say, gee, I better take some profit and start picking up some of these tech stocks for the future. Is that a pretty rational approach, do you think, that many fund managers will eventually have?
Yeah, I think they will, and I think there's good reason. There's a good price for everything. If you're buying a good car, the quality of the product is one consideration, and then the price is the other consideration. And tech stocks are exactly the same. And like I say, a lot of these tech stocks still have fairly good business opportunities in front of them. Their business segments are growing. The adoption of the technologies that they're offering is growing, and so the primary headwind that they're facing is not so much a deterioration in the business landscape that they're addressing. It's principally just a valuation thing to do with the increase in risk-free rates. So there will come a time, depending on how much more, if any, the market declines over the course of the Ukraine war. There will come a time when these stocks, on their own merits and given the fact that they offer much higher growth rates, will look attractive again. And I think that's the one. It's different to, say, the tech wreck or even the financial crisis. We haven't seen a material deterioration in the business landscapes for a lot of tech stocks. In fact, a lot of the business landscapes continue to accelerate, and that's the one big difference. Their primary headwind is really valuation now, which is, we'll find the appropriate price at some stage, and then start attracting investment attention again.
Okay, all my questions so far have been really easy, Brenton, but one last one. If a beloved family or friend came to you and said, give me one stock that you really think looks like good value to hold for a year or two, what would that stock be?
Metcash.
Metcash.
In the consumer staples area, we like it for a couple of reasons. One, it trades at about 50 to 60% of the valuation of something like Woolworths. It's benefiting from a change in consumer behavior that has seen more and more of us spend at least part of our working weeks from home. It has a much higher suburban and regional presence than the other consumer discretionaries, and that's just in the grocery and retail area. The other really exciting part of Metcash is really their hardware business. Their hardware business is now almost half of that business. It's benefiting from a combination of both organic and acquisitive growth. There are a lot of synergies still to be realized as a result of the integration of some of these businesses, giving them access to some of the broader scale systems and distribution that a business like Metcash offers. And then you can get it on a 6% dividend yield, and at 40 or 50% of the valuation of Woolworths at the same time. So, we just think it has so much going for it. It's got valuation, it's got tailwinds, it's got pricing power associated with inflation, and it pays a good yield.
Well, I know when I picked my granddaughter up from swimming yesterday, the first thing she said was she wants to go to the IGA. And Metcash
That's
clearly.
Right.
Okay, Brenton, thanks for coming on the program.
Peter, thank you for your time. Cheers.
That's Brenton Saunders from the Pendle Midcap Strategy. I'm joined now by Marcus Bogdan, who's the fund manager of the Switzer Dividend Growth Fund and also is the founder of Blackmore Capital. And we're going to see how he's playing the market with all this worries around the war, rising oil and commodity prices, and just to see how he's reacting, particularly given the fact that the German stock market was up nearly 8% overnight, clearly on better news than what has been prevailing in recent times. Marcus, thanks for joining us.
Good morning, Peter. Good to be here.
Have you dealt with many wars in your investing lifetime?
There've been a number of different crises since the beginning of the 2000s, but this is obviously significant, and it's also significant for what you're alluding to is the impact that that's having on a range of commodities around the world. And that's particularly relevant to the Australian market, where we're a resource and energy rich country.
Yeah. Well, I made a note in my story today that, the German market, I think, was down about 12 or 13% before the big rise overnight. We were down about 3%, and part of the reason is that we actually have a lot of the stocks that have been doing well, energy stocks, resource stocks, and for a while financials were doing well, but financials weren't helped by the concerns over, well, what banks might be affected by Russia or the Ukraine. So we were a beneficiary of the war in a sense, but what's happening today, and what do you expect to happen if this war problem starts to dissipate?
Well, I think that the focus will then go more squarely back to the direction of interest rates and how these global economies are facing into continued elevated inflation. That is problematic that the markets have to solve. But underlying that is that there's underlying strength in the broader economy, and that is leading to better than expected earnings results, both from a profit and a dividend perspective. And so, we're fundamentally focused on the fundamentals of the underlying companies that we've got investments in.
Yeah. So in many ways, what we're seeing then is, if for example, the war in Ukraine starts to become less of an issue, and we saw overnight two things happen. One is OPEC decided to effectively take sides, increase production of oil, and that's driven oil price down. Good for the global economy, give our global economy a tick. And then we also saw the possibility that Ukraine could be saying to themselves, well, we might make ourselves a neutral country, that might get Putin off our back, that might then take away the threat of war. And all those things have really helped the market go up today. So if over time then that is the situation, the war actually starts becoming less of an issue, then we focus on a rebounding global economy, which you've alluded to, which helps companies' profits. And then, because the new worry will be interest rates and inflation. But in that context, do you think that's overall a win for stocks over 2022?
I think if you can negate the negativity that we've had and we go back to the other issue is the pandemic and COVID, hopefully that's now starting to dissipate. The second issue was obviously around the war in Ukraine. And the third issue is around inflation. So if two out of those three issues can take a step back, and then we still have to navigate our way through these higher persistent inflationary pressures. Now, one of the things that you're alluding to, obviously, if there is greater supply in terms of oil, that some of the issues around the energy crisis dissipate, well, that will take some pressure off inflation as well. And then the focus will be, well, how are the global economies navigating through the remainder of 2022?
Okay, so what are you seeing in your collection of funds, in your stocks you've got in your fund? What are you seeing at the moment?
Well, we've seen absolutely an elevated performance on the materials and the resources sector. I'm not just talking, I'm talking over the last month or so. So very strong performances in companies like BHP, which are, a significant part of the portfolio of just around 10% or so. So they've delivered very strong results. Companies such as Santos and Northern Star, for the first time in several years, we're starting to see some outperformance on the gold sector. Now, if what you're saying those issues start to dilute somewhat, then I think you'll see the other parts of the portfolio start to recover nicely. Today, for example, we're seeing a strong return in the performance of the financials. Macquarie is well up, and then companies like Commonwealth Bank and National Australia Bank are also very strong performers as well.
So, have there been any new additions to the fund? Have you kicked any stock out of the fund?
Yes, we have made a change in the last week. We have sold Ampol, which has been an outperformer over the last year by a considerable amount. And we do think that energy prices will remain elevated and that could have an impact on the level of demand for refined products. And so we're happy to stay long the sort of the upstream assets of BHP and Santos that are beneficiaries of these higher prices. And also we're looking to increase the dividend yield in the portfolio. And so we've acquired a toll road operator called Atlas Arteria, which used to be part of the Macquarie Group. Yeah. And Atlas Arteria own and operate and develop 4 toll roads in France, Germany, and the US. And pleasingly, they provide a dividend yield of greater than 6%. So that's been the addition into the portfolio. And the third adjustment that we've made is that we've got an investment in Integral Diagnostics, which is a radiology and diagnostic group in Australia. They are having a rights issue. We're participating in that rights issue because we do believe that one of the beneficiaries as the influence of COVID recedes is a recovery in healthcare and particularly in healthcare stocks.
It's part of the reason why you hold CSL in the portfolio as well, I presume.
Yes, CSL, Ramsay, Integral and Helios. So we're well represented in the portfolio because we do believe that this is a very strong long-term theme that we're playing.
All right, Marcus, thanks for joining us. Talk to you in a few weeks' time.
Pleasure. Thanks, Peter.
That's Marcus Bogdan of Blackmore Capital. Well, I regularly get questions, something like this. Are REITs exposed to the office box in the CBDs of Australian cities under threat, with workers all wanting to work from home? Or, I ask myself the question, are these the classic cases of what Warren Buffett would say are stocks to be greedy because others are fearful and scared to buy them? So that's what I'll look at today about REITs. I've looked at 4 well-known REITs, and I will look at them after this interview with Dr. Shane Geha, who's an urban planning expert of EG Advisory. Welcome to the program, Shane.
Thank you, Peter. I understand that this morning we're exploring the post-COVID CBD situation.
Yeah,
and
exactly
it's
right. And you have a pretty strong view on the matter.
I do. It's obviously something we've all had a long think about, Peter, because the reality is that we are all worried about what the post-pandemic CBD office environment world will look like, both from an institutional point of view in terms of owning assets, but also from the point of view of how much space, which we're all renting in the city, of course, and how much space do we need? How much does it cost? Is it a sustainable outcome? What sort of things should we be thinking about in terms of work from home versus work from the office?
Okay. Let me just, for people who are listening, explain to people what your background is.
Well, I studied civil engineering initially and then land economics, and then I did a PhD in town planning. So my expertise straddles both construction and the zoning of land. And today, EG is a multi-dimensional company. EG is the company I founded with Michael Leeson and Adam Geha 22 years ago. And we basically have a very large investment arm, which basically centers on the value add space. And we still run a very large advisory practice in the difficult zoning and planning space, which probably is one of the largest of its kind in the country. And we also have a large prop tech business called Willow, which is centered around the digital twin technology. So our understanding of property and land, I think, would be pretty diverse.
Okay, right. So you're coming from the point of view of what is to happen to the value and the use of properties in the CBD, and you have a proposition that there should be more effort made to make or to encourage employees to come back to the workplace. What are the main arguments for that?
Well, the way I've seen it during the pandemic, Peter, is that problem solving almost went out of the window when people were not in the one room together. I thought morale and team spirit was severely affected. I mean, for a day or two or three or a week or two, you can sustain having people in disparate places talking on a screen. But the reality that we have witnessed and that I've experienced personally over the last 2 years is that it's not too good for team morale. You don't actually feel like an organization. You really feel like just talented individuals in different places. Also, I think the discipline of coming to an office is quite important. They're getting up in the morning. It's almost like a Pavlov dog experiment item, if you recall what that was. Pavlov basically found that and he won the Nobel Prize for science for it. And the experiment that he did was that if you actually conditioned the dogs to have a bell when they ate, then eventually he would just sound the bell and the dogs would salivate even without food being there. So, and every single organism on the planet has a conditioned reflex. So part of me being dressed up this morning for work is a significant factor in alerting my brain to the fact that I am going to work, I'm going to concentrate on work, I have the discipline mentally and physically of work. Now, that's not to say that some flexibility is not able to be done. And I think what the pandemic has taught us is that there's a lot of things now that are set up at home that can be done remotely, particularly for specific tasks. So if I had an employee or a manager that had a 14-hour task to do, sometimes it could be better for them. It could be worse, by the way, but sometimes it could be better for them to be concentrating alone at home outside of a work environment. But in terms of team morale, in terms of building the spirit of the company, in terms of the ethos of the firm, in terms of that discipline of coming to work, and in terms of problem solving, which almost goes out of the window when we're not together in one room, I think it's essential to encourage people to come back to the team environment in the office.
Yeah. Are you seeing the comeback of workers in the office 5 days a week as a distinct possibility, or do you think the hybrid model is more likely to prevail in the years going forward?
Well, we've espoused the hybrid model enormously in the last 2 years, and we've had good reason to do that. We've had a pandemic. We've reacted to it in a very universal way across the globe, rightly or wrongly. It's been you would agree, everyone would agree that it's been almost a unilateral reaction across the globe. So our reality is that a lot of people are now used to not coming in on 1 or 2 or 3 days a week. Whether that is sustainable in the long term, I'm not sure. A lot of companies are saying they would like to offer flexibility, and that's an important thing. Yeah, but remember, Peter, flexibility is not a KPI. Flexibility is a subset to a KPI. Flexibility is me making my employees happy enough to produce more. That's all it is. So if at the end of the day, the productivity isn't increased, which it may well not, by the way, using this model, then we might have to rethink how we do things.
Do you think it's going to lead to a lot of employers who do want their staff in the workplace, but but the staff are saying no, that it will lead to them wondering whether they can get cheaper services in other countries of the world because, in a sense, they're being forced to have employees who work remote?
It's a distinct possibility, and I hope it doesn't come to that, because one of the things that saved Australia during the pandemic, you as an economist will attest to this perhaps, is the fact that we had pretty close to full employment. And our unemployment rate didn't drop much below 5% throughout the last 2 years, right?
Yeah.
That's been an absolute savior during the pandemic. Imagine the 91 recession, if you recollect it as well as I do, Peter, with 12% unemployment at one point, lots of people that can't find jobs. It was an low ability for access to credit. Businesses couldn't survive. It was diabolical. I mean, it took us 3 years to recover from the 91 recession.
Yeah, and there was no internet to make people capable of either working at home or even creating their own businesses, which they've done nowadays.
That's correct. I hope that we will think hard about the employment. The other thing is it takes a lot to get a CBD to work. I mean, and a CBD is an animal with many parts to its body. So if you think of the retail in the CBD that many of the ASX listed companies rely on, shopping centres, retail strips, other items, museums, they all rely on their revenue on a conglomeration and a density of workers being there at the same time. So if you reduce that, you may actually find other problems stem from the lack of people being agglomerated into one place.
Okay, before Christmas, I was fortunate enough to have lunch with a man who knows a little bit about property, Harry Triggerboff, which I'm sure. And I said to Harry, well, with the offices being vacated for the reasons we're talking about, workers not wanting to come back, what's the likelihood that many offices will be turned into residential apartment blocks? And he said, well, I'd like it to happen. He said, but there's a lot of planning regulations and planning people that are in the way. Do you see that would be a good thing for example, Sydney or Melbourne, for the CBD to have a lot more residential apartments, replacing the offices that currently are becoming ghost offices? And secondly, do we need governments to jump on these people in planning who are creating obstacles to that kind of innovation?
Well, the first thing to say is that the obstacles are real because the zoning and planning systems are very difficult to change quickly. They're clunky. They require massive processes for radical change to turn an office building into a residential. That's first thing. Second thing is there are many commercial imperatives, Peter, that are a problem. And that is that if I've got I'm in Governor Phillip Tower, it's an A-class building, it's magnificent. So even if this were vacant at one point, which it isn't, to convert it to residential would mean that you have to wait till the end of its economic life, because simply destroying an asset that's still got a lot before the end of its economic life cannot make a feasibility stack no matter what you do.
Yeah.
So all of these buildings that are halfway through their economic life or less will not change anyway. That it's impossible. The places where you would put residential and could be very successful is at the fringes of cities. All really big cities that are successful have those. Now, what they will also be able to allow you to do is to change moderately low office rent, like in that kind of city fringe on the outskirts of Sydney CBD, sort of almost like a K.5 or 2 Ks out from the centre here. Yeah. They could be very successful conversions. They will also allow a lot of people to live within almost walking distance to work. Yeah. So that could be a possibility. And those buildings, a lot of them are at the end of their economic life and they're reaching that renewal kind of phase. But the problem is once you convert them to resi, because resi is a higher and better use, they will never, ever go back to office. So should you grow Australia and Sydney into a 10 million, if you grow Sydney, say, into a 10 million person city, and you suddenly need a bigger CBD, it is kind of hard to see where the extra space will come from other than destroying existing buildings and going much taller.
But
So they're the challenges.
do you think it would be a positive for a city like Sydney that is a big also tourism mecca as well, to actually have a lot more people living in the city? So, in a sense, the amenities required for the people living would be great for tourists as well. Better restaurants.
Yes,
more
absolutely.
popular.
In fact, we're building more hotels in the CBD. That's very important because it gives you your after hours life. I mean, after 5 o'clock on a Friday to 9 o'clock on Monday, you don't want a ghost town in a world city like Sydney. You don't want it to be a ghost town. You want the streets to be buzzing with activity. So that requires more residential to be nearby, better public transport access for people to come in. And people have to have things to do. They've got to be world-class restaurants, world-class museums. There's got to be stuff. So if you've got nothing to do in the city, why would you come?
Yeah.
So I see that there is an absolute imperative, as you are saying, to revitalise the CBD, and residential will do that. So definitely in the right places, residential should be encouraged, and Sydney CBD should be a lot bigger. By the way, I've advocated for many years that it's too short. It should be a lot taller. You should actually be able to put more residential and more commercial all in the one spot using the same space.
Yeah. Okay, the last big question for people who've listened to this interesting interview but want to make money out of it as well, Shane. REITs, are they going to be under pressure for some time until we actually see how many workers we can get back in the CBD?
I think so. They will be, but it will subside. My father, rest his soul, used to say, the good will pass, the bad will pass too. Everything will pass. So my view is the pandemic was partly driven by a genuine health fear of people traveling to the city or being on public transport or being in an office with others. That will subside very soon, if not sooner. Then the idea of having offices occupied will become an important consideration for all companies, including ours. I mean, we like our workers to be together with us in the one space. Now, if that's not possible, then what you're saying will, if for whatever reason, I doubt that will be the case, but if it's not possible and it's not a convincing argument for employees who all want to kind of do a hybrid model, then the additional space will definitely be a challenge for REITs, because remember, they value their buildings based on income, and that income requires rental yields and rental growth.
Okay. So for the patient investor, would you think REITs are a buying opportunity now, or is it still in a too hard basket for you?
No, I would buy. I mean, who was it that once said you should buy when the market says things are down, and you should sell when the market says things are up?
Yeah, I think Buffett said, "Be greedy when other people are fearful."
That's the right advice, and he knows one or two things about investing. Yeah. But I think the market's in very good shape. The supply equation is still very, very tight for lots of. So if you wanted to build a brand new office building in the city of Sydney or Melbourne today, it's really hard to do. Hard to find the land, hard to get the approval, and the building is the easiest part actually. So it's limited stock. So that tells me that long term it's a very good investment. It's a good hold, and I certainly would be thinking about it as a long-term hold. And that means that if the assets are strong, the REITs will be strong in the medium to long term.
Shane, thanks for joining us.
Thank you, Peter.
And that's Dr. Shane Geha. Now, I've taken the FN Arena survey by analysts who specialise in REITs and had a look at what they're saying about some of the high-flying companies on the stock exchange, which we call REITs, Real Estate Investment Trusts. Now, Dexus, average gain 13.9%, but the biggest one is 19% from Morgan Stanley. GPT, average gains expected to be 12.9% over the year or so, but Ord Minnett thinks it could be a 17% gain. Looking at a famous one called Charter Hall Long WALE REIT, it was CLW8. A 4% gain is the average, but Morgan Stanley thinks a 14% gain's out there. And when it comes to Centuria's office stock, which is COF, it's a ticker code, 11.9% is the average gain, and 16% Morgan Stanley says is a possibility for this particular company. Now, as you can see, they're all pretty good gains. The analysts effectively like REITs, but they are not really over enthusiastic saying they're going to be massive returns. I suspect over time these companies will find more supporters or buyers of these particular stocks. But right now, greed has a bit of competition from fear. The chart below of Dexus shows it was once a $13.90 stock and is now $10.70. Potentially, that is a 30% gain, plus if these stocks eventually come back to where they used to be. And by the way, a company like Dexus pays about a 5% dividend, which is unfranked, still making it a pretty interesting investment. And that's the show for this week. Thanks for joining us. Don't forget, we're back on Monday. If you want to know more about the stocks that we think are worth buying or possibly selling, have a look at switzerreport.com.au. That's where all the information can be found. Thanks for joining us. See you on Monday.